According to the Nobel Prize-winning economist Robert Shiller, the S&P 500 index is currently more expensive than it has been in practically its entire history. And in this video, I'm going to show you one simple trick that could help you minimize losses and reduce risk in a bear market, which could be just around the corner. First, I'll explain what the trick is and talk about some of the pros and cons of investing using this strategy. Then I'll show you a real-world example of how it works and what the results would be. So what am I talking about? Well, it's dollar cost averaging, or DCA for short, which has been proven time and again to be one of the most effective ways to reduce risk of investing in volatile markets. What is dollar cost averaging? Well, simply put, it's when you divide up your investment dollars over a period of months or potentially even years, as opposed to just taking a whole lump sum and putting it all into the market at once. So let's say that you have $10,000 right now that you want to sink into the market because you're feeling some FOMO after watching TikTok videos of 16-year-old investors retiring off their Dogecoin profits. You have two options for investing that money. First, you could just do some due diligence and pour everything into the markets ASAP, or you could spread out your purchases over a longer period of time, also known as dollar cost averaging. The goal with dollar cost averaging is to reduce the impact of a massive crash on your portfolio. If the market crashed the day after you invested your full $10,000, you would be very, very sad. But if you were doing the dollar cost average method, you would actually probably be happy, because that means you'd be able to buy in at a much lower price. Now, studies have shown that in normal precedented times, investing the lump sum usually leads to better long-term results because it's very difficult to try to time the market. However, if you believe that the stock market is currently overvalued and you're worried about a potential crash and you don't want to see your portfolio get cut in half overnight, then the dollar cost average method is the way to go. Now let's talk about some of the pros and cons of this strategy before I show you a real-world example. On the pro side, you've got reduced risk. You don't have to worry about the timing. There's much less stress, which can't be discounted because, let's be honest, who needs more stress? And finally, there's much greater upside to this, i.e. you could make more money if there actually is a crash during the time when you're doing your dollar cost averaging. The reason for that is when the stock market is low, of course, you can buy more shares of whatever you're investing in for that money. So when things turn around and the stock market starts to go in the other direction again, you stand to profit. Of course, there are a couple of cons to the dollar cost averaging strategy, and the main one is that you could potentially be leaving some profits on the table. Generally speaking, the market goes up over time, and if you're spreading out your investments over months or even years, you're potentially missing out on some gain, especially if there isn't a crash like you were expecting. Now, to illustrate the point, let's go back to 2020 when the pandemic started and there was that big stock market crash. So here I'm using this portfolio backtesting tool to show you what the difference would have been between lump sum investing in 2020 versus dollar cost averaging. So let's assume that you had $12,000 to invest, or $1,000 per month. If you invested the full $12,000 at the beginning of 2020, your final balance at the end of the year would have been $14,205. And you can see here that in March, when there was that big crash, your balance would have been down to $9,600. So you would have lost a decent chunk of your investment. Now, from that point in March, obviously things picked up and you still would have ended the year in the black, but you would not have maximized your profits using the lump sum method. Of course, hindsight is always 20/20, and we could say that if you invested the full $12,000 in March at the absolute trough during the crash, you would have maximized your profits. But timing the market like that is next to impossible. And if you think that the market is overvalued, then the next best thing that you can do is dollar cost averaging. So let's look at that strategy and the results. So if we look at the DCA strategy and the results over the same time period, 2020, but instead of investing $12,000 upfront, if you just put $1,000 each and every month, what would the results be? Well, you can see that at the end of the year, you would have a final balance of $15,532. So even if you have been holding that money back in reserve, waiting to invest it over a longer period of time, you still would have made more. And the reason for that, of course, is after the crash in March, you could have bought many more shares of the SPY index fund. And for the next couple of months, while the stock market was recovering, there was an opportunity to invest in lower prices than the previous all-time high, get in at that better price. And so that's why this strategy would have outperformed the lump sum strategy in 2020. And the same results would apply if we look back at other stock market crashes. For instance, in 2008, when we had the financial crisis, if you had invested a lump sum, you would not have been very happy. But if you had been using the dollar cost averaging strategy because you felt that the market was overvalued, then you would have been purchasing many more shares at a fraction of the cost. And actually back then, the stock market did not recover to its previous all-time highs until sometime in 2012 or 2013. So it was 4 or 5 years before things rebounded. So if you're sitting on some cash right now and you're thinking about investing it, this is definitely something to consider, especially if you do believe that the stock market is currently overvalued. And if you want to learn about what investors like Warren Buffett look for when they're trying to find undervalued companies in an overvalued market, then check out this video right here. Thanks, and I'll see you in the next one.